Well, apparently all the experts out there expect the market to break into new lows in 2023. So we need to talk about what exactly that means to you, what exactly these experts are saying, and exactly kind of what the truth is kind of behind all this there. So that way there's not a lot of confusion out there. And there was a great video out there put out on this, so we'll talk about that today. I just ask in exchange for you to gently tap that like button and consider subscribing too. I mean, a lot of you guys watch the channel and aren't subscribed yet, so go ahead and just subscribe. That's just really all I ask. All right, this video was put out about a week or so, but it's talking about 2023, basically the end of this year, going into the beginning of next year there, and kind of what's going to happen and how the markets are going to make new lows and why and all that good stuff right there. So let's dive into the video and see exactly what it says, and I'll let you know my take on it as well.
Stocks may be up so far in Q4, but our next guest says that could be a warning sign for recession next year. Tony Dwyer is the chief market strategist at Canaccord Genuity. Tony, great to see you. You've been listening into our conversation, and in the context of your call for the last quarter of the year was for the S&P to go up between 8 and 12%. We've gone through that. We've discussed that on the desk. So how are you viewing the rest of the year going into 2023?
So you're up now 13% for the quarter. You've never had the S&P 500 down more than 10% for the first 3 quarters, and then had the fourth quarter up more than 12%, which means you should give back some of the gain that we've got. I think it's you got to be careful because you don't want to get too negative. The range at the year end, it was a year end call, not a during the quarter call. At the year end, we should be up, based on history, somewhere between 8 to 12%. We're up a little more than that, but it doesn't mean you go out and sell everything. I think, as you know, I'm expecting a recession next year. I'm pretty convicted on it, which means you go back.
Wait a second. This guy's saying he expects a recession next year as if the Fed isn't actively trying to induce a recession. Is that, I'm sorry, I just find this sort of stuff funny that we're still having this conversation about, are we going to have a recession? Are we not going to have a recession? One, we already had a technical recession earlier this year, and I know we've discussed that on this channel probably since about March or so, that we were going to see a technical recession this year. And two, the Fed is actively trying to induce a recession, so why in the world would anybody be surprised or thinking we're going to have a recession? That's what the freaking Fed wants, is a recession. I don't know. I'm confused. Anyways, let's get back to the video, guys.
Starting to do that as well. There does seem to be a disconnect.
It really, breadth comes in and you go back and retest the lows. It would be historically unique. So there's 3 things that, Mel, that we're looking at, and the viewers can track it. The 3 things we're looking at, it's not just the yield curves. Anytime the percentage of yield curves that are inverted gets above 55%. So you don't use the 210, the 3 month, people pick whatever one they want for the day. Let's use them all.
Exactly what I was trying to say.
Anytime you've had more than 55% of them inverted, you've gone into a recession. We have 82% as of early this week. We had 82% of them inverted. The leading economic indicators, anytime that you've had them at the current level, you've been in or going in.
Again, that's exactly what the Fed was trying to do, was trying to induce a recession. That's why you're seeing all those yield curves, if I could talk. Anyways, that's why you're seeing all those yield curves kind of inverting, is because that's exactly what the Fed's trying to do there.
Recession, and the Philly Fed diffusion at 1-month diffusion index, which is kind of an interesting indicator. It looks at really the labor difference.
The Philly Fund diffusion and refusion, I don't know. That sounds more like a science term, something like I don't know. Anyway, sounds like something Doc Brown would say, not something a stock analyst would say. But hey, whatever.
Labor metrics for each state, and the Philly Fed measures it versus a month ago when it's hit this negative a level, you've gone into recession. So I'm not, you know me by now, Mel. I change my opinion like 50 times a day every time there's a tick. So I got to.
So he actually calls himself out right there, which is exactly why Warren Buffett and Peter Lynch and all those guys don't care about the macroeconomist guys and all these guys analyzing all these charts and graphs and everything else. They change their mind 50 times because the data changes 50 times. And each time when they pull up a new data point, it points to something different and all that sort of stuff like that. I get it. It makes for great content. It makes for great YouTube content where people can throw up a nice, pretty chart and a nice little graph that shows this, that, and the other, and this is what's going to happen. And then everybody can make 75 different predictions. But like this guy just said, if you're making 50 a day, even if you're right 20% of the time, it seems like you're right a lot because that means you're right 10 times. But the reality is, when you're changing your mind 50 times, how right are you really? And is it really worth all that hassle and all that sort of stuff like that to look at these sort of things when basically we all know exactly what's happening? And I'm just waiting for stuff to go to undervalued and then super undervalued territory to buy. All the rest of this sort of stuff, as you can clearly tell, you don't change your mind 50 times unless you're basically guessing, is kind of the bottom line with that.
By the data. And the data is very clear that it would be historically unique with these indicators the way they are not to go into recession, and it would be historically unique for the market to not bottom during the recession. In other words, you haven't made the low yet.
TD, it's Tim. But there is some data, and there are some parts. There's a bull market somewhere, always, right? And so there's parts of what's going on both in the economy and in terms of asset allocation that should work now. I like gold here. I like emerging. I think some of the delayed reopening trades, like some of the airlines and casinos, and they have some fundamentals behind them. What do you do in this environment where we've had a 17% move off that CP?
These are typical Wall Street moves. Hey, we're already, basically seeing huge drawdowns in all the stocks. We're coming into a recession, but I think airlines is going to be a good play. Let's just go with airlines and gold, and let's just choose and casinos, because when people get broke and they can't afford the bills, they go gamble, right? That's just makes perfect sense.
Low in October.
I think you got to start getting defensive when you're above that 12% level and you're expecting a new low. As you know, I've been pretty neutral and been very tactical.
And again, something I want to point out here, guys, what exactly is expecting a new low? We saw the low, you see it right there on the chart. You see it there in June, and then we hit it again there, right around the same level in October. Could we make a new low? Absolutely we could. Unless something catastrophic happens with the economy, we'll go right back down to those levels. But like we saw, the difference between the June lows and the October lows was some of our favorite stocks hit lows in June and weren't anywhere near the lows in October whenever the market hit new lows again. Some of those stocks were up over 100% from those lows. Some of them were up 30%, 40% from those lows whenever the market made a new low the very next time around. So that's why I don't really care as much about making new lows and stuff like that in the context of my own personal stocks, because I'm not buying index funds. I'm not buying the S&P 500. So why the heck would I care that the S&P 500 hits a new low during that stage? Because I don't know. I don't own it. I care about my stocks inside of it. And if I had to guess, I'd say if that happened, it probably means my Apple and some of those stocks like that got beat up. Well, some of my other stocks that have been beaten down forever probably started on a little bit of a run, are probably up better. We saw that, the difference between the June low and the October low as well. It's kind of those larger caps that are starting to come down, and those smaller caps kind of started to recover a little bit. So we'll wait and see. It's not a guess, it's not anything else like that. But that's why a lot of this sort of talk is kind of ridiculous, and people fearing a new low. Like Michael Burry was basically saying, hey, June was just the beginning. We got another 50% to drop from there. It's like, okay, generally when they're talking about these new lows, that's not what they're talking about is another 50% leg down from the October low. They're talking about another 5 to 10% down from those lows in the indexes overall. The stocks inside of those indexes were obviously going to perform vastly different than that. So kind of keep that in mind whenever you're hearing stuff like this.
They're based on a whole bunch of indicators. So we had the fall, now we've had the year-end rally. You've maxed that out. I think you start to get defensive the more above plus 12% you get, and as you exit the year. We're in the temporary sweet spot. The fundamental excuse for this oversold rally is that the Fed's initial moves have lowered inflation. Bono had this right, where the drop in the goods inflation, it's the note we wrote about today, the drop in goods inflation it's really coming down because we've transitioned from buying stuff. It's Christmas every day at the Dwyer's with Amazon. The presents show up and you open them every day. From buying stuff when we're in a pandemic to doing stuff. And that creates a problem because the lower inflation on the goods prices are coming down, used car prices, those things. But the problem is, as Bono said before, you get a lift in the services inflation. And Jerome Powell said yesterday specifically, he doesn't expect housing related or non-housing related services to start dropping until next year. So you're in the temporary sweet spot where you've slowed it enough to keep the goods side down, so you're off peak inflation, but the services is going to keep it up above where they want it. And that creates the challenge for the Fed and the risk really into the first quarter.
Well, the good news right there with that is that the Fed is basically already saying they know that's the case and they know that's going to change next year. So that, kind of gives them leeway to not be super aggressive because the numbers are being a little more stubborn than they think they want them to be and then they want them to be. The other note that I wanted to make there was notice how he said, you need to get defensive this next quarter. That's a trading concept. It's not something I do as a long-term buy and hold investor. Long-term buy and hold investors being defensive basically means, hey, I'm going to relax and chill out for a little bit here and kind of wait for deals to come. I'm not going to FOMO into a rally. I'm going to wait and see what comes to me and bull up my cash in the meantime. That's what basically I would take that as. The people that are wanting to, hey, switch from this, now switch over to that stock and then switch back into that, that's trading. And that's just a game you don't want to play at all, at least not as a long-term buy and hold investor. Anyways, kind of when you're looking at this here, guys, and when you're definitely thinking about a recession for next year, this is not unknown. This is not an anomaly. This is not something that's unexpected or anything else like that. I never understood the narrative as to why people wanted to say, are we going to go into recession? Are we not going to go into recession? The question has never been that. The Fed is actively, without saying it directly, but all their actions have lined up for, hey, we're going to put us in a little bit of a recession here, put us in a little bit of a recession here to slow the pace of inflation down. And it means pain in certain areas like, hey, housing, mortgages, stuff like that. It's going to be rough out there in certain areas, certain industries. Obviously, the market got really, really rough as soon as they started doing all this sort of stuff. And the stock market is always 6 months ahead of everything else. But if the Fed can manage to engineer a mild recession, which right now they're doing so far, it's still early. We still got another 6-8 months to get all the way through all this sort of stuff. But for right now, that's what they're seeing. And that to me is the only question that's left. Do we have a more softish type recession, or do we have a more hard type recession? So we have now had 7 recessions, at least, technical recessions, since 1980. So my question to you guys is, outside of the Great Recession and, the illness crash, can you name any of the other 5 recessions that we've had? My guess is that's a tall order from most people to be able to name all 5, which basically tells you they were very mild recessions. And that's honestly what most recessions end up being, is they end up being very mild overall. So to act like it's crazy that the Fed can't engineer a mild recession is honestly not true. Now, I'm not saying they can't screw it up. I'm not saying they will not screw it up, because it's absolutely possible they have. They've screwed up in the past over and over again. But so far, they've done a good job with this, and it is possible that they can do it. So I'm not going to go around making wild speculative bets and wild speculative claims right now based upon something that may or may not happen later. So kind of keep that top of mind as you're kind of working through all this. And when you hear recession talk, understand exactly what we're looking at and exactly what history says and exactly what we're kind of dealing with now. So hopefully this was helpful. And if you don't know how to get a price target or how to do a valuation and want a step-by-step process for doing that, building wealth, and you want direct access to me and much more, remember to check out the pinned comment down below to become a member and at least look at everything you get. And click this video here for the stocks I'm still buying in this market, and click here for exactly what I'm doing to make huge money in this market. So thanks for watching, and we'll see you in the next one.